In a flurry of since-deleted tweets over the weekend, Michael Burry said that U.S. stocks still had further to fall, linked the current market decline to the start of the dot-com disaster, and predicted many investors would suffer terrible losses. The investor from The Big Short fame tweeted on Friday that 218 companies have their primary stock listed in the U.S., have a market valuation of over $1 billion, and have annual losses of more than $100 million. He noted that 29 of them have a market capitalization of over $10 billion and are together worth $655 billion. In a tweet, Burry said the current market environment reminded him of the second half of 2000, when some underappreciated stocks were trading at steep discounts and high-flying names still had further to fall. Burry blamed exchange-traded funds, ETFs, and index funds for blindly inflating asset values in a subsequent tweet. He also warned that many investors will be crushed as they all ran for the exits, likening the market to a crowded theater. Burry is best known for his $1 billion wager against the housing boom in the middle of the 2000s, which was detailed in the book and movie The Big Short. The previous year, he also bet against Elon Musk's Tesla and Cathie Wood's ARK Innovation Fund and bought shares of GameStop before it turned into a meme company. For some time, Science CDO has been forecasting a catastrophic market crash. In June of last year, he called attention to the greatest speculative bubble of all time in all things and predicted it would result in the mother of all disasters. What is a bear market rally? A bear market rally is a sudden, brief increase in share prices that occurs during a longer-term bear market slump. Rallies in bear markets can be dangerous for investors who begin to believe incorrectly that they herald the end of a protracted downturn. The disappointment of individuals who bought during a bear market rally contributes to prices reaching new lows when the primary negative trend reasserts itself. The statistics of the stock market: between 1901 and 2015, every bad market gave rise to at least one 5% rally. Over that time, 2/3 of 21 bad markets were broken by rallies of 10% or more. Since the top on December 31, we have developed a pattern of decreasing 8 to 10%, rising 5%, falling another 8 to 10%, and then rising 5%. Burry makes a few points that are important to think about. First, he points out that more than 13 equities have closed above their 200-day moving average as of right now, and that the absolute bottom usually happens when that figure is close to 5. This remained true throughout 2009, 2011, and 2020, with the dot-com bubble burst being the lone exception. Second, he claims that all the foolishness must end. There are 29 companies with a market cap of more than $10 billion and 218 enterprises worth more than $1 billion that still lose $100 million annually. Then he observes that inflation occurs in spurts. Biden or Powell won't have anything to do with the spike's eventual resolution, because it is the core and character of inflation it will be. It resolves, deceives people, and then reverses course. When it returns, neither the Fed nor the POTUS will claim the credit. Burry proposed that a widespread shift of assets from actively managed funds to passive index funds is a contributing factor to the problem. He referred to it as the IQ drain of passive investing. New day trading patterns have increased risk. Unsophisticated traders are entering the market and making bets based on recommendations from social media forums and so-called meme stocks. The most convincing illustration of this was GameStop, which in less than 30 days climbed from less than $20 per share to $483, then back down to approximately $50 per share. It's important to remember that Burry made $270 million from the GameStop roller coaster. All options, which can be profitable when judiciously leveraged by knowledgeable traders, are of special interest to these same rookie traders. Unfortunately, novice day traders who are adopting these tactics are purposefully taking high-risk positions with what seems to be a lack of consideration for possible outcomes. In social media trading groups, hashtags like #BlowOffTop and #CautionToTheWind to the wind are frequently used. A correction is inevitable given the unjustified rise in stock values, and according to Burry, one is likely to occur within the next 12 months. It might begin with equities that are enormously overvalued, such as Tesla, owned by Elon Musk, which Burry has shorted. This year, the prices of many of the most well-liked meme stocks have collapsed. AMC Entertainment fell by 69%, GameStop fell by 34%, and Bed Bath & Beyond fell by 54%. Similar trends have been observed with the top special-purpose acquisition firms. Shares of Virgin Galactic and Lucid have also decreased significantly this year, by 57% and 64% respectively. Burry argued repeatedly that the pandemic-era booms in meme stocks, cryptocurrency, SPACs, and other trendy assets wouldn't persist. So that's it for today's picks, guys. I hope you liked the video. Please leave a like and be sure to subscribe to my channel.